Welcome back to Morning Trade Live. Time to focus on the big picture ahead of the opening bell. Jim Bianco is with us, President Bianco Research. Thank you so much for being with us. Obviously, a lot of talk about Jay Powell's speech on Friday at Jackson Hole. What were your thoughts?
You know, it was the same speech he gave last year for the same reason, looking for the same outcome. Last year, he said, there's problems in the labor market. I'm worried we're going to cut rates. This year, he said exactly the same thing. Last year, they cut rates and 10-year yields went up 100 basis points because it turned out those problems in the labor market weren't there. We'll see if the problems in the labor market are there now because inflation at the core level is running over 3%. And if he starts cutting rates next month and the labor market isn't as dire as he thinks it is, we're going to get a repeat of last year. We're going to see long-term yields go up, not go down. We're going to see mortgage rates go up. We're not going to see them go down.
That is such a great point because we started to get concerned. We started to see 4.5 and people started to talk about a new range for the 10-year bond yield. Right now we're at 4.28. What do you think the range could be?
Well, I think it has been, the 10-year yield and the 30-year for that fact have been dead range bound now since pretty much a couple of weeks after Liberation Day, middle of April. It seems to be around 430 plus or minus about 20 basis points. And that's where I think it's probably going to stay until we get a resolution. What's the economy doing? Is it slowing down or is inflation heating back up? And then we'll get a breakout of that range. Now, I'm kind of in the camp that inflation is heating back up and then ultimately we'll get a breakout of that range towards higher yields. It might not be immediately, but I think it's definitely coming here sometime soon. And don't forget too, the end of next week, we're going to get payrolls. And on September 11th, we're going to get CPI. Those are both before the September 18th meeting, FOMC meeting. If either one of those numbers or both of those numbers are above consensus showing a stronger economy, higher inflation, then this whole narrative about a September rate cut could also be thrown into chaos as well, too. So the final chapter has not been written about a September rate cut just yet.
No, and it's actually has fluctuated over the last week or so, but it seemed more likely when he expressed the concern about the labor market, and with the revisions, then you start to see the trend. If, assuming those numbers were right, or at least the trend was right, it showed weakness not for 1 month, but for multiple months. In the meantime, when we think about how investors should proceed here, how do you proceed? I mean, in a market that could maybe be volatile.
Well, yeah, I mean, this is the big question that investors are going to have because you basically have, the way I measure it is you have two stock markets, right? You have 10 stocks, which are the Mag 7, throw in a couple of other ones too, maybe Palantir and some others, into the AI technology camp, and they trade their own way, and they have a huge weighting in the stock market. Then you've got the other 490 stocks in the S&P and say the Russell 2000 stocks. They've been struggling. I know the Russell 2000 finally made a new all-time high last week, but it hasn't really outperformed bonds this year. And what really drove them up was things like interest rate sensitive stocks like the housing sector and the like. So interest rates are going to matter if you're not playing in the technology sector. And that's what you have to keep your eye on. Now, if you're going to be playing Palantir and if you're going to be playing Nvidia for its earnings and the like, I don't think interest rates are going to matter a whole lot there. It's really going to be more about, AI adoption and whether or not we're going to get more build outs in hyperscalers. So that's really where you're going to see the story on that side. So for right now, I think this interest rate story, if you're playing in everything else, is going to matter quite a bit. And it's going to be, I think, an open question. So investors shouldn't be sure that, the rest of the stock market's just going to go up because the Fed is going to provide that necessary relief.
Let's talk about now these big names that we're watching. I mean, Intel, the government takes this 10% stake, and Kevin Hassett saying the government's likely to continue to do so with other companies, taking stakes in other companies. We also have Nvidia reporting this week. So 2 names in the news. Are these both names you would buy into, maybe for long term?
Well, yeah, let me start with the Intel numbers and with the Intel story, and let me not mince words here. It's been a crappy company. The stock is down 50% while all the other semis are up 120% over the last 2 years. It is struggling and it got a government bailout. Now, if you think that the problem with Intel is they just need a little bit more government money and they can compete with AMD and they can compete with Nvidia, then you should buy that stock. I don't see how the government stepping in and giving them more money is going to be the case. Remember, Silicon Valley has got unlimited money right now. Anybody in Silicon Valley could have done this deal with Intel, and they all passed on it. And that should speak volumes about it. So I'm not high on this company as well. And Nvidia, I think, is really going to be the story of the week when it comes to earnings, because it's been the story, every time it does report. It sets the tone for the market, especially the week before Labor Day. I think, if you ask me what's the biggest economic stat of the week, it's going to be Nvidia's earnings. And they have had a tendency to beat. And I think that there's going to be a lot of whispers that they're going to do that as well, too. So they're going to be setting up very high expectations.
Is it a name you like for the long term, or you feel like it's run up too much, or do you buy ahead of the earnings, after earnings? Because people like these kinds of names, I guess, for long term. We were just talking about Stifel and Baird raising their targets. They're both above $200.
No, I mean, if I was to put it into baseball terms, this is a seventh, eighth inning stock right now. If you believe in the AI story, we have to start, to use the Wall Street parlance, we have to start shifting away from the picks and shovel plays, like the people that make the chips and build the data centers. And we have to start thinking about playing on who is going to create content in this. This is not unlike 2000, right? In 2000, everybody was buying Cisco thinking that it made routers for the internet and it was going to be the biggest play in the internet. But what you needed to be doing was shifting to the eBays and the Amazons and the content providers. And eventually, when they came public a couple of years later, like the Facebooks, the content providers of the internet. And I think we got to start thinking about who is going to make content with these AIs and not who's going to just continue to build the infrastructure. I think the infrastructure play, like I said, is in the seventh or eighth inning.
And do you foresee more highs for the market overall between now and the end of the year? And I'd like to be more specific, because you have the tech-heavy NASDAQ, you have small caps, you have the S&P 500, which also is somewhat tech-heavy. But, do you think they all sort of can move higher between now and the end of the year, or hit some new highs?
Well, if you take the NASDAQ 100 out of there, and if you take all the tech stocks out of there, I think it really is going to come down to a case about interest rates. Remember now that the Russell 2000, the total market cap of the Russell 2000 is less than Nvidia right now. So it's not even one Mag 7 stock, the whole Russell 2000. And it is probably going to be driven more by interest rates than anything else. And again, if the Fed winds up, cutting rates and the market and the 10-year yield, 30-year yield rejected and go up, I think those stocks will continue to struggle. But like I was saying earlier, I think that the technology stocks, the AI stocks, they are going to be impervious to interest rates. They're going to be playing in their own different ball game, and it might be determined by Nvidia's earnings on Wednesday, at least over the near term.
Yeah, understood. When we think about what the Fed does, I mean, at least in part, there are people who thought the Fed should lower rates just to sort of normalize it versus other countries that have cut their rates. What do you think of that?
If you look at the other countries that have cut rates, and mainly we're talking about the UK and we're talking about the ECB, they've been cutting rates for over a year, 7 to 10 rate cuts. Their 10-year yield is higher now than it was when they started cutting rates. That is, again, a central bank can cut rates anytime they want. The mistake everybody makes is when the central bank cuts rates, long-term yields go down. They're not in the UK. They're not in ECB or in the Eurozone. Those yields are going up because there's a bigger fear of inflation than there is of a growth slowdown. And that's the mistake. Yeah, cut rates just to be sure. And then when you get a 5% 10-year note, you're not going to be thinking that that's such a good idea. That's the risk you face. Is the market more worried about inflation, or is it more worried about growth? And I'll give you one quick stat. On August 1st, 2 minutes before the payroll report came out, the 30-year yield was at 491. Today, it's like 3 basis points lower than that. It's not falling on this talk that the Fed is going to cut rates. It doesn't think it's a good idea. And if it does follow through with these rate cuts, it might start going up and mortgage rates won't come down.
All right. Jim Bianco of Bianco Research. Always great to talk to you, Jim. Thank you so much.